Hello, everybody. This is Alan Ellman, the blue collar investor, and welcome to this BCI podcast number 100. Wow, I can't believe that I've done 100 of these already. More to come. This one is titled Analyzing LEAPS for the Poor Man's Covered Call Strategy. We're going to be using a real life example with Intel Corp, which trades on the NASDAQ exchange under the ticker symbol INTC. Let's start this podcast by first defining what is the Poor Man's Covered Call Strategy, or PMCC. Well, technically, the term is a long call diagonal debit spread, but in essence, it's covered call writing. But instead of using a stock as the underlying security in a long position, we use a long-term call option known as a LEAPS option, normally 1 to 2 years out. So it's used as a stock surrogate. Now, as with all strategies, the poor man's covered call has its advantages and its disadvantages. But the main reason this strategy is attractive to retail investors is that it costs a lot less money to enter the covered call trade, simply because options cost less than the stocks themselves. And because the cost is lower, the return on capital will be that much higher. But as I said, there are disadvantages to the strategy, and that's something you must understand before you make a decision that this is the right strategy for you and your family. It may be and it may not be. All right, let's focus now in on the best delta to use for these long LEAPS positions. So a LEAPS, again, is a call option with expirations 9 to 24 months out. Now, the reason we use in the money strikes lower than the current market value of the stock is because the delta of those options will be closer to 1 than to 0. The closer the delta is to 1, the more the price action of that option will simulate that of the underlying stock or exchange traded fund. The BCI guideline is to use deltas of 0.75 or higher for our LEAPS strike position or our long position. Now, frequently there'll be many strikes to choose from. So which one are we going to select? Well, we have certain criteria that's going to help guide us to those best strike selections. For example, the cost of the LEAPS option. The deeper in the money it is, the greater the intrinsic value, and therefore the higher the cost. So how much cash is available in our portfolio? That's certainly one important factor. Also, the strike must align with our initial trade execution formula, which is the difference between the long and the short call strikes, plus the initial premium must be greater than the money we spend to buy that LEAPS option. That information is available in my books and online courses related to the poor man's covered call. But there is an initial structuring formula that must be met before starting or entering a poor man's covered call trade. Finally, the time value that we generate when we sell the short call, which is generally out of the money or higher than current market value, must coincide with our stated goals. Now, for traditional covered call writing, my goal is generally 2 to 4%. In the poor man's covered call, since our cost basis is lower, then those returns will be significantly higher than 2 to 4%, maybe by another 2%. So whatever our goal is, that initial structuring formula must meet our stated goals. Okay, let's now turn to a real life example of Intel Corp, which was trading at 58.30 on May 18th, 2020, when I created this video. Now, the $60 out of the money short call, which expired on 6/19, so a month expiration, had a bid price of $1.75 per share. Now, the LEAPS option chain for the January 21st, 2022 LEAPS option, so more than a year and a half out, actually had 8 eligible deep in the money strikes showing deltas ranging from 0.779 to 0.9059. In other words, all greater than the 0.75 guideline part of the BCI methodology. So there were 8 choices we can select from. Now, for those of you who are also watching this podcast, I'm now showing a screenshot of the option chain. To those just listening, I will describe it. Recall that Intel was trading at 58.30. So we're going to look at the strikes ranging from a high of 42.50 to a low of 25. The option chain showed deltas of 0.7798 for the 42.50 highest strike to 0.9059 for the 25 lowest strike. So the deeper in the money we go, the higher the delta, the more that option will simulate the price movement of Intel. We're going to focus in on one of the middle ones, the 35 strike, which showed a delta of 0.856, certainly meeting our criteria of greater than 0.75. And that had an ask price, if we were to purchase that LEAPS option, of 25.55, certainly less than half of the current market value of Intel, which was trading at 58.30. Okay, let's move on to the next slide now. If we put this information into the BCI Poor Man's Covered Call Calculator, we first enter the information in the white cells at the top of the spreadsheet, showing a trade date of 5/18, an expiration of the short call of 6/19, so 1 month out, current market value 58.30, and we're going to use a long leap strike price of 35, deep in the money. That's going to cost us $25.55 per share. Again, much lower than the 58.30 per share. The leaps expired on January 21st, 2022, about a year and a half out. And the short call strike was out of the money, or $60 short call strike, which generated a premium of $1.75. So what information is gleaned from the Poor Man's Covered Call Calculator? And this is the initial trade setup. First of all, we want to see the initial trade had a positive outcome regarding the difference between the strikes plus the initial premium of $1.75 had to be greater than the cost of the leaps, $25.55. Spreadsheet shows it was in fact greater by $1.20 per share. So the initial structuring formula is approved and met. Now the initial return on the short call is 6.85%. And again, that's because the cost basis is much lower than the cost of the stock, where we normally get a 2 to 4% return. Now we have about almost a 7% 1 month return on the short call. Also, we have an opportunity for an additional 6.65% if the price of Intel moves from 58.30 up to the $60 short call strike. So wow, we have more than a 13%, 13.50% precisely for the 1 month return as a max return. And that annualizes out, folks, to 154%. That doesn't mean we're going to get it, but that's how the initial trade was structured. So let's summarize now the factors relating to delta as far as strike selection for the leaps position. Delta is important because we want the security price to simulate that of the underlying stock. So the deeper in the money we go, then the closer the delta will be to 1. Also, the poor man's covered call traditionally is a long-term position where we're constantly using that same security over a long period of time. Now, there are several parameters that we must achieve to get the best results, and that includes the initial trade structuring formula. Let me reiterate that again. It's the difference between the long and short call strikes plus the initial premium generated must be greater than the cost of the leaps option, and it was by $1.20 per share in the case of Intel. Now, the BCI Poor Man's Covered Call Calculator will be particularly helpful in establishing our trades. And There are also 4 additional tabs for managing the poor man's covered call trades. So once again, before I go, folks, I just want to highlight to you the BCI, or our best and most comprehensive investment package ever offered by the blue collar investor. You will need nothing else. It includes 6 online video courses, 6 calculators created by the blue collar investors, so found nowhere else, 5 of our best selling books in ebook format, and our annual premium membership, which is 13 months of membership, which includes all the reports for the best securities for all aspects of option selling, as well as continuing training videos. We have almost 200 now, and we add 1 or more each month. So you get continuous training and many other files and resources for option selling. You could find the link to the BCI package on our website. Look for the link that says BCI package. Those watching this podcast, I have it circled on the screenshot in front of you. Ladies and gentlemen, I want to thank you very much for taking the time to watch this and listen to this BCI podcast, number 100, Analyzing Leaps for the Poor Man's Covered Call Strategy. Folks, I hope you enjoyed this presentation, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.